In this video, I'm going to share with you everything you need to know to build wealth and retire early through property investing in 3 simple steps. Hi everyone, it's Derek here from Global Property Investors, where we help the average Australian get started on their property investment journey and share our own personal experiences and tips on building wealth through property. Now, before we get into it, I just want to preface this video by saying that I am not a financial advisor, and the information shared in this video is not a substitute for financial advice from a professional who is aware of your unique circumstances. That being said, however, I do own an investment portfolio of multiple properties myself that generate tens of thousands of dollars of steady passive income per month, so I'll be sharing with you exactly how I did it. This video will be a bit of a longer one, but it will be packed with value because we'll be going through the high-level strategies of everything you need to understand in order to start your property investment journey. Make sure you stick around to the end of this video, where I'll be also offering a special bonus you don't want to miss out on. But first, it is important to understand 2 fundamental concepts first. Number 1, why should you invest in properties at all in the first place? Typically, we find that the reason people tend to invest in properties are for these 5 reasons. In the short term, property investing can help you. Number 1, create residual passive income. Number 2, minimize tax and redirect it into building your own wealth. And if we're thinking of more long-term reason, the end game it is to essentially. Number 3, create capital growth in properties so that. Number 4, we can achieve financial freedom and security. And number 5, retire early and comfortably. I'll say for most people, being able to retire early with financial security is the dream, so that you can spend more time actually doing what you want in life. And to do so, you have to look at investing beyond the traditional grind of working 9 to 5. Now, the second thing is to understand why property. Why invest in property as compared to any other investment option available? Statistics shows that the value of home in Australia has doubled approximately every 10 years over the last 4 to 5 decades. And considering this return on investment compared to if you were to accumulate interest with cash in the bank, this makes property a very ideal investment option. For example's sake, if you were to save a deposit of $100,000 and put it in a high interest saving account at a bank, earning interest at 4%, you would earn approximately $4,000 approximately per annum. And if you keep that account for 5 years, the interest would compound to approximately $25,000 over that period. However, if you were to have invested the same $100,000 into purchasing a property, for example, a $500,000 home, you would need to borrow around $400,000, and assuming that you're paying 6% interest on the loan, which equates to $24,000 in interest per annum, and then let's say you rented the property out for $500 per week, this would equate to $26,000 in rental income that you will get. So essentially, the rent is helping you pay off your mortgage. However, we also need to factor in the average growth rate of the property, which is currently sitting at 10%. Let's take a conservative figure for this scenario. Let's assume the property appreciates at 5% per annum. Over 5 years, the property will grow at approximately $25,000 per annum. This means over 5 years, you would have made approximately $125,000 in capital growth and equity, which is 5 times more than the $24,000 interest you would have earned if you put your money in a bank account. Now, in terms of property as compared to any other investments, such as stocks, etc., it is not an area I have ever fully dabbled into, so I won't make any comments about this at this point of time. All I can say is that my personal preference is to invest in property, as it is a tangible asset that is less volatile in my opinion. Property in the medium to long term has historically never failed, with the right mindset and strategies in place, of course. And if you'd like to stick with me to learn more about the strategies to invest properly, please make sure you give us a thumbs up and subscribe to follow along. Alright, so now that we've gotten the why out of the way, now let's get into the actual juicy stuff and talk about the actual strategy and the exact 3 concepts that you need to understand to start building wealth through property. Step 1, we must come up with a plan. Let's say our goal is to be able to reach financial freedom and create a steady stream of passive income so that we can retire early. The first question we have to answer is, what does financial freedom look like for you? For me, it looks like retiring at 45 with my current owner-occupied home fully paid off and making at least $3,000 a week net disposable income to provide for my wife and kids comfortably. But for someone else, financial freedom may look like simply being debt-free and not tied down to a property or a job, and being able to travel freely. Feel free to pause this video to write down what your ideas of financial freedom looks like. Okay, now that you have the picture of your financially secured future in mind, let's calculate how much passive income you would need to make in order to achieve this goal. For the rest of the video, I'm going to use a typical example of an Australian Joe. Let's call him Bob. So Bob currently makes $100,000 per year. He's currently 32 years old, single, and his goal is to retire by the time he's 50. His idea of financially free life requires a paid-off home with approximately $1,200 per week of passive income coming in. This is a comfortable amount of income to be receiving, considering he does not have any mortgage or rent to pay. So now that we have a passive income goal in mind, how do we actually get there? Step 2. Now let's talk strategy. Simply put, if Bob's income goal is $1,200 per week clear, we would need to have a home that he lives in, fully paid off, plus 2 investment property, fully paid off, by the time he retires at the age of 50. What do I mean by that? Assuming each fully paid off investment property that he owns yields $750 in rent per week. After deducting expenses and maintenance costs, he'll be left with approximately $600 per property. So multiply this by 2 investment property, he'll have $1,200 worth of rent collected per week, which is enough to sustain a comfortable retirement for himself. That sounds simple enough, but how do we get to this point, you may ask? Bob can achieve this by accumulating 1 property every 3 years for the next 18 years until he reaches his retirement age of 50 years old. Let me explain. Fast forward 18 years later, following our plan, Bob now has 6 investment property. Let's say his average property purchase was $600,000. Over the last 18 years, as the Australian property trend suggests, the property would have at the very least doubled in value, if not more. So now each property on average is now worth $1.2 million, making Bob's gross asset worth now more than $7.2 million. Assuming Bob paid interest only on his loan over the last 18 years and still owes $3 million in total for all his 6 property, Bob would need to sell around 3 homes to clear off his debt. That means he still has 2 to 3 homes left in his portfolio that is essentially paid off, which equates to approximately $3.6 million worth of paid asset to his name. In other words, if Bob took 18 years to generate $3.6 million worth of asset, $3.6 million divided by 18 is $200,000 per year. So Bob has added roughly $200,000 to his wealth each year, as well as created 3 monthly rent generating assets, which together will probably generate more than his passive income goal of $1,200 per week. Imagine instead of investing in property, Bob did what everyone else does and just tried to save money from their 9-to-5 job. Bob will probably only at most be saving $20,000 per year from his salary. Compounded that in a high interest saving account over 18 years would roughly equate to $420,000 in savings. So if you think about it, it's actually a pretty simple strategy. But why do most people not follow through with property investing though? The simple answer is, most people either don't know how to or they fear the unknown. People don't want to make speculation about the property market in case it doesn't work out for them. But in my opinion, if you invest in the long term with the right strategy, property in the medium to long term has never failed, for me at least. If you think about it, Australia needs to build 200 to 250,000 more homes in the next 2 years to accommodate for the 700,000 migrants that will be coming to Australia. This means that there is always a demand for more housing, and it is in the best interest of the government to help promote and fund growth of properties, which also in turn create more jobs to stimulate the economy. Property growth isn't going anywhere. You can sit there and hesitate and try to time the market, but the truth is, time is one thing that you can't get back. So my friends, my number 1 philosophy in investing is, don't wait to buy property and wait. Now coming up next, we'll get into the 3rd and final step of our property investing journey. But first, comment below if you have any questions so far about property investing in general, and maybe we'll answer your question in the next video. So the last and final step in today's video is step 3. Let's go through a quick rundown of practical tips that you can use to get started on your property investment journey today. Tip 1. What are the fundamentals of a good investment? The typical person likes to buy close to where they live, but remember, the best investment should be logical and not based on emotions. The right mindset is that as long as the number stacks up, it's a good investment. Most people think that a good area to invest in is the one that has shops, schools and transport, but don't be fooled guys. Many suburbs already have this. For me, it's all about jobs and infrastructure. A good investment for me would be in an area that has, number one, choose an area that is supported by a multi-sector economy. What I mean by that is that don't choose a suburb or an area that's actually heavily reliant on just one industry such as mining. Instead, find an area that's actually supported by a lot of industries such as health, retail, education, industrial. In this way, it promotes a lot of growth. Number two, find an area where there will be a lot of private and public sector investments in infrastructure such as new roads, business centers, shopping centers, schools, airports, ports. Let us know in the comment below if you'd like us to make a separate video on how to learn about and research which area are good to buy in. Tip number two, what do you need to start investing today? You would need about 10% of the value of the property in savings and allocate approximately 5% for additional costs such as stamp duty and legal fees. Bank pre-approval to borrow, which is normally based on the client's affordability and serviceability by considering their income, expenditure, and savings, and ideally a dual income of at least $100,000. You would also need 3 professionals in your team, a good accountant, lawyer, and a broker. Once you invest in your first few properties, you notice it starts to get easier as you accumulate savings through minimized tax and increased positive cash flow. But that's a video for another day. The last and final tip number 3. How can you increase your likelihood to retire faster? Obviously, there are many ways to approach and live life. But if your goal is to accumulate passive income, generating assets so that you can be financially secure and retire early, what I recommend is save money in your 20s so that you can invest as soon as you can. Start investing and continue to work in your 30s. And if you follow this, by the time you get to your 40s, you can start to enjoy and relax more with your passive income. If your situation is not what I just mentioned, just know that it is never late to start. I mean, this life isn't for everyone. You may want to spend your 20s experiencing life, traveling freely, which is equally valid too. But just keep in mind that time is your best friend, and it's much easier to start investing earlier as you have compounding time and interest on your side. Perhaps it's really worthwhile for you to really sit down and think about what sort of life you envision when you're 40 or 50 years old, and if your current lifestyle will be able to support that. So earlier, I promised for all those who watched to the end, I'll be giving you something that you don't want to miss out on. So here it is. In this video, we gave a lot of examples based on assumptions. But of course, everyone's situation is different, so it's crucial for you to do your own due diligence and research. That being said, if you watch this video and you want to learn more about getting started on your property investment journey, for an indefinite time, you can reach out to me for a quick chat, and together we can determine what your goals are and work out a property plan to get you started. I'll post a link in the description below. I'm not sure how long I'll be taking this course, so click below so you don't miss out. And that's all for today, guys. That's pretty much the high-level strategy of what we need to know to start your property investment journey. Of course, we only really scratched the surface, so in future videos, I'll go into greater details on other topics such as step-by-step on how to put the strategy into practice and how to pay down your property and retire early. So make sure you hit the notification bell so you don't miss out. If you made it this far, thanks for watching and I'll see you in the next one. Bye guys.